Hi guys and welcome. This is Dom from the Trading Academy. I hope everybody is doing well. This is a UK tax guide for prop firm traders. I've been meaning to do this video for a little while after a couple of questions in the Discord, so finally here we are. It's taken me a little while to put together. As you can imagine, this is a very complex topic, so I've taken some time to do some research. I've actually spoken to some people myself, and now I feel like I'm in a position where I can present this to you guys. So if you trade with any prop firm, whether that's a big well-known name or a smaller one and you're based in the UK, then this guide's for you. I'm going to walk you through exactly how your payouts are taxed, what your options are for how you set yourself up, what you can legitimately deduct, and what HMRC actually expects from you in terms of records. This is going to be a pretty long, detailed session, and that's deliberate. And as I mentioned, tax genuinely is complicated, and a lot of what's floating around online about this topic is either a little bit out of date or was never quite right to begin with. Every single figure in this guide has been checked against current HMRC guidance for the 2025-2026 tax year. Rates change constantly. National insurance for the self-employed has changed twice in the last 2 years alone, and the income tax threshold for the additional rate has moved down significantly since some of the most commonly shared trading tax content out there was first recorded. So if something in here differs from a video you've seen before, it's likely because that other content is simply just out of date, not because this is wrong. Okay, so let's get into it. So before we go any further, I need to be really clear about something. This guide is for educational and entertainment purposes only. It does not constitute financial, tax or legal advice, and nothing in this presentation should be relied upon as a substitute for advice from a qualified professional. I'm not a qualified or certified accountant, tax advisor or financial professional. The information covered in this guide reflects general research and publicly available HMRC guidance at the time of recording. Tax rules change, and individual circumstances vary significantly from person to person. Before you make any decisions about your own tax position, please speak to a qualified accountant, ideally one who has direct experience with traders and prop firm income specifically. Okay, with that said, let's get into the guide properly. So let's start with the single most important concept in this entire guide, because if you get this part wrong, everything else falls apart. Prop firm payouts are not capital gains, and they are not tax-free. Here's why. When you trade with a prop firm, you are not investing your own money and holding an asset. You are using someone else's capital to try to generate a return, and in exchange they pay you a share of the profit as a reward for that service. That's the key word here, service. That's exactly why almost every single prop firm contract refers to you as an independent contractor or a self-employed trader. You're invoicing them for your share of the profits, exactly the same as any other service provider would. Think of it like this. If you clean someone's house and they pay you £100, that's income. If you help a firm grow an account and they pay you £1,000, that is exactly the same category of thing. It's a service and it's been paid for. Now, how does this differ from capital gains? Capital gains tax applies to a one-off gain. You buy an asset, you hold it for a period of time, and then you sell it. Prop firm payouts are the complete opposite of that. They're repeated income earned by actively trading someone else's capital as your trade or your business. HMRC has a specific concept for this called the badges of trade. It's used to help decide whether an activity counts as trading for tax purposes, and things like frequency, organisation and your intention to profit all point very clearly toward prop firm payouts being trading income, not a capital gain. If you want to read the full legal test yourself, search badges of trade on gov.co.uk. It's pretty useful background reading. Okay, so let's bust some of the most common myths I hear about this, because I guarantee you've heard at least one of them, maybe all four. Myth number one, it's a demo account, so there's no tax. This is actually correct while it's on the demo, but the moment your payout lands as real money in your real bank account, that is the point at which it becomes taxable income. Myth number two, and this is a big one, the prop firm's offshore, so HMR can't see it. This is completely irrelevant to your tax position. You are taxed based on where you are a tax resident, not based on where the firm is registered or based. It genuinely does not matter if the firm is in Prague, Dubai, the Cayman Islands or anywhere else in the world. The money landing in your UK bank account is what matters, full stop. Myth number three, it's trading so it must be capital gains, or it must be like spread betting. No, you're being paid for a service which is growing someone else's capital, and that makes it trading income, not an investment gain and not a tax-free spread bet. And myth number 4, if it's under £1,000, I don't have to declare it. This one's partially true, but it gets misapplied constantly, and there's an important distinction to make here. I'm going to cover the actual rule properly later in this guide on the trading allowance side, so just hold on to that thought for now. Now let's talk about how you structure yourself. In the UK, you have 2 clear options for receiving prop firm income: sole trader or limited company. Let's go through sole trader first. This is the simplest route. You register as self-employed with HMRC, you keep a record of your income and expenses, and you file a self-assessment tax return once a year. You pay income tax and national insurance based on your profits. It's straightforward and it has fewer running costs, and it comes with a lot less admin. Now the limited company route. Here the company itself pays corporation tax on its profits, and then you extract money from the company as either a salary, dividends, or a mix of both. This can be more tax efficient at higher, more consistent income levels, but it comes with more admin, more filing requirements, and higher accountancy costs. So which one's right for you? Here's the rule of thumb I want you to take away from this slide in particular. Prove that you can make consistent money as a sole trader first. Move to a limited company once your income is consistent and substantial, not before. Setting up a limited company before you've proven you can trade profitably and consistently just adds friction, cost, and admin for no real benefit yet. And if that friction puts you off from even starting, it's counterproductive. I also want to flag a misconception that's everywhere online. A lot of people think setting up a limited company automatically reduces their tax bill. It doesn't, not on its own. If you pull all the profits straight out of the company as soon as it lands, you're paying corporation tax and then personal tax on top. And that can end up costing you more than staying as a sole trader, not less. The actual saving in a limited company usually comes from retaining profit inside the company rather than drawing it all out immediately, or from structuring and timing how and when you take the money out. It's not an automatic discount just because the word limited is in your business name. And this is a decision you should revisit once your income is consistent, not something you should lock in day one and forget about. Okay, so this next slide is generally one of the most important in the whole guide because every single worked example that follows is built directly on these numbers. So pay close attention here. These are the UK income tax bands for the 2025-2026 tax year. Your personal allowance is £12,570. You pay 0% tax on income up to that amount. Above that, from £12,571 up to £50,270, you're in the basic rate band and you pay 20% tax. Above that, from £50,271 up to £125,140, you're in the higher rate band and you pay 40% tax. And above £125,140, you're in the additional rate band and you pay 45% tax. Now here's something important I want to flag directly. A lot of tax content aimed at traders, including some popular videos on this exact topic, still quote the additional rate threshold as £150,000. That figure was cut down to £125,140 a few years ago, and it's stayed there since. So if you watched other content on this subject and it mentioned £150,000, that content is now out of date. Always check gov.uk directly for the current figures, this guide included, because these things do change. Now let's talk about national insurance for the self-employed, because this is an area that has changed a lot in the last couple of years, and most of the content out there covering this topic hasn't caught up. There are 2 classes of national insurance that used to apply to self-employed traders, Class 2 and Class 4. Let's start with Class 2. So as of April 2024, Class 2 national insurance is no longer compulsory for most self-employed people. If your profit is above the small profits threshold, which sits around £7,100, you now get a qualifying year towards your state pension completely automatically with nothing at all to pay. And this is a significant change from how things used to work. Now Class 4 national insurance. This is 6% on profits between £12,570 and £50,270, and then 2% on anything above that. And here's the important bit. This rate has dropped twice in recent years. It used to be 9%, and a lot of the guides and videos still floating around online are using that old 9% figure. So if you're calculating your own numbers based on something you watched a while ago, you're almost certainly overestimating what you owe. Always check gov.uk for the current rate before you assume an older figure still applies, because this has been one of the fastest moving areas of tax policy for traders over the last 2 years. So let's put those numbers into practice with a real worked example. Here's the scenario, okay? You've got a full-time job paying you £30,000 a year, and on top of that, you've made £70,000 in prop firm payouts in the same tax year as a sole trader. So let's break down what you actually owe. Your job already uses up your personal allowance and part of your basic rate band. Once we account for that, the income tax attributable specifically to your prop firm income comes out to approximately £23,946. On top of that, you'll pay class 4 national insurance on your self-employed profit, which comes to approximately £2,657. Add those together and your total deduction from your £70,000 in payouts is approximately £26,603, which works out to around 38%. That leaves you with a take-home amount from your prop firm income of approximately £43,397. Now, why does so much of this land in the higher rate band? It's because your salary already fills most of your £12,570 personal allowance, and it uses up part of your 20% basic rate band too. That means most of your prop firm income on top of that salary gets pushed straight into the 40% higher rate band. This is exactly the mental model to use for your own numbers. Start with the £50,270 higher rate threshold, subtract whatever you earn from your job, and whatever is left over is your remaining room in the 20% band before your prop income starts being taxed at 40%. One important caveat before we move on, this is a simplified example. Okay, real liabilities can vary depending on things like pension contributions, student loan repayments, gift aid donations, any other income you have, and other relief that might apply to your specific situation. So treat this as a model for how the maths works, not as a precise prediction of your own bill. Now let's look at a second scenario. Same £70,000 in prop firm payouts, but this time it's your only source of income, no job on the side. So we'll run the same numbers here. Your income tax in this scenario comes out to approximately £15,432. Your class 4 national insurance is the same as before, approximately £2,657, because that's based purely on your self-employment profit. Add those together and your total deduction is approximately £18,089, which works out to around 26%. That leaves you with a take-home amount of approximately £51,911. Now, compare that to the first example. Same £70,000, but here you're keeping significantly more of it, roughly £8,500 more. Why? Because in this scenario, you get to use your full personal allowance and you stay in the lower tax bands for longer, simply because there's no job salary already eating into them. And I want you to take away one important lesson from comparing these two examples. Your total tax bill on prop firm income is entirely dependent on what else you're earning in that same tax year. It's never a fixed percentage. Anyone tells you prop firm income is taxed at exactly this percentage is oversimplifying, because it depends on your full financial picture for that year. And the same caveat from the last slide applies here too. This is a simplified example and your real number will move depending on things like pension contributions, student loans, gift aid, and other reliefs. Now, let's talk about the limited company route properly, because this involves two separate types of tax and it's important for you to understand both. First, corporation tax. If your company's profit is up to £50,000, you pay 19% corporation tax. Between £50,000 and £250,000, the rate tapers, working out to somewhere roughly between 19 and 25%, depending on exactly where your profit falls. And above £250,000, you pay a flat 25%. So that's tax number one, paid by the company on its profits. Now tax number two. Once you want to take that money out of the company and into your own pocket, you'll typically do that through dividends, and dividends have their own tax rules. The first £500 of dividends you receive each year is completely tax-free. Above that £500 allowance, you pay 8.75% if you're a basic rate taxpayer, 33.75% if you're a higher rate taxpayer, and 39.35% if you're an additional rate taxpayer. And which band you fall into depends on your total income, not just the size of the dividend itself. I want to flag something important here. These dividend tax rates have risen in recent years, and at the same time that tax-free dividend allowance has shrunk considerably. It used to be £2,000 and now it's down to just £500, and this matters a lot because it directly narrows the tax advantage that limited companies used to have over sole trader status, which is exactly what we're going to look at on the next couple of slides. So let's run through a worked example through the limited company structure so you can see how this actually plays out with real numbers. Here's the scenario. £70,000 of prop firm profit run entirely through a limited company and paid out to you entirely as dividends. So we'll break this down. Your company profit is £70,000. Applying the tapered corporation tax, your corporation tax bill comes to approximately £14,800. That leaves approximately £55,200 available to pay out to yourself as dividends. On that dividend amount, your personal dividend tax, which will vary depending on what other income you have, comes to approximately £13,394. Once you account for both the corporation tax and the personal dividend tax, your approximate take home comes to around £41,806. Now, I need to be really upfront with you about something here. This is a deliberately simplified illustration. There's no salary being paid in this example, no expenses being deducted, and the entire profit is extracted as dividends in the very same tax year. In reality, proper limited company tax planning involves choosing a tax efficient salary to pay yourself, deciding how much profit to retain inside the company versus draw out personally, and working within the current national insurance secondary threshold rules. All of that genuinely needs a specialist accountant to optimise properly. This simplified version exists purely to show you the mechanism of how the two taxes stack, not to give you an exact number you should rely on for your own situation. So here's the question everyone wants answered. Sole trader or limited company, which one wins? So let's compare the two examples we've just worked through using the same £30,000 salary plus £70,000 prop firm income scenario. As a sole trader, your take home was approximately £43,397, which is 38% deduction. Through a limited company, your take home was approximately £41,806, which is 40% deduction. In this specific illustrated example, the sole trader route comes out slightly ahead. Now, this is different to what a lot of older content on the topic concludes. So let me explain why, and then let me be careful about what this does and doesn't mean. Corporation tax on profits above £50,000 has risen since 2023, and dividend tax rates has increased at the same as the tax-free dividend allowance has shrunk. Together, these changes have narrowed the advantage that limited companies used to have at this income level. But I want to be very clear about something important. This comparison assumes you take every single pound of profit straight out of the company in the same year with no planning whatsoever. And that's not how a specialist accountant would approach this for a real client. Retaining profit inside the company instead of drawing it all out, pension contributions, planning around a spouse or co-director, optimising the salary and dividend split, and timing exactly when dividends are taken can all shift this comparison meaningfully, sometimes enough to flip the answer entirely. So please don't take this slide as a universal rule that sole trader always wins. Take it as proof that the old rule of thumb that a limited company automatically saves you money is no longer reliably true, and that the actual answer depends entirely on your specific numbers and how well the extraction is planned. If you ask a specialist accountant this exact question, the honest answer they'll give you is almost always, it depends. And that's the correct answer, that's the answer you want to hear, and not an accountant avoiding a straight response. So let's talk about VAT next, because this becomes relevant once your income starts to grow. And I want to be genuinely careful with this section because it's an area where it's very easy to oversimplify. First, the registration threshold, which is the one part of this that's straightforward. You must register for VAT once your taxable turnover passes £90,000 in any 12-month period. That threshold rose from £85,000 back in April 2024. So as a rough guide, if you're averaging somewhere around £7,500 or more per month across all your prop firm payouts combined, start that conversation with an accountant now, not after you've already crossed the threshold. Now here's the part I want to be really careful with. Whether that actually applies to payments you receive from an overseas prop firm depends on what are called place of supply rules. That depends on factors like where the firm belongs for VAT purposes, the exact contractual arrangement you have with them, and whether the supply is legally classified as taxable outside the scope of UK VAT entirely or zero rated. Those are three legally distinct categories with different meanings, and which one applies to your specific situation is not something you or I should be guessing from a video. It depends on the specifics of your arrangement. Separately, if you start coaching or mentoring or selling courses alongside trading, which is incredibly common in the space, that income sits in a different category again, usually standard rated at 20%. So there are at least 2, sometimes 3 different VAT treatments potentially in play, depending on exactly what you're doing and who you're doing it for. My honest advice here is simple. Don't try to self-diagnose your VAT position from general content like this. Take your specific contractual setup to an accountant once you're anywhere near the threshold and let them tell you exactly which category your income falls into. Okay, so let's talk about something a lot more positive, expenses, because this is where you can reduce what you owe. The test HMRC applies here is that an expense must be, and I'm using their exact word in here, wholly and exclusively for the purpose of your trade. Here's a list of things that typically qualify. So your prop firm fee challenges and any retake fees if you've had to attempt to challenge more than once. Software subscriptions, so things like charting platforms, data feeds, journaling tools. Hardware, so computer, monitors, tablets, laptops that you use for trading. A percentage of your home broadband, phone and utility costs since you're trading from home. Office equipment too, so a desk, a decent chair, standing desk if it's used for your trading setup. Accountancy and tax advisory fees, yes, the cost of getting help with your tax itself is tax deductible. Education material that's directly related to your trading, a rented office or workspace if you're using it for your trading. And if you also coach or mentor or create content around your trading, things like webcams, microphones, recording equipment can potentially be claimed too, though that starts to shade into a different part of your business, so keep that distinction in mind. One important point on all of this, keep every single receipt. A card machine printout that just shows a supplier name and an amount is not enough evidence on its own. HMRC will want to see a detailed receipt that shows what was purchased so that they can clearly attribute that expense to your trade. Okay, so let's talk about record keeping, because this is one of the easiest things to get right, and it'll save you a huge amount of stress if HMRC ever do ask questions. There's 2 things that matter here, proof of income and proof of expenses. For income evidence, you want bank statements showing your payouts actually landed in your account, payout reconciliation statements from the prop firm itself, invoices you sent to the firm if that's how your particular arrangement works. And I want to add one more thing that's easy to overlook. Keep PDF copies of everything. Invoices, payout confirmations, challenge purchase emails, all of it. Don't rely solely on being able to log back into a prop firm's portal to pull this information later, because prop firms can and do close down. They get acquired or they migrate entirely to new platforms, and when that happens, your historical records can simply disappear with them. Download and save your own copies as you go. For expense evidence, you want detailed receipts, not just card payment references, a bank statement showing where that payment came from, and ideally a note of what the purchase was for, especially if it's not immediately obvious from the receipt alone. So here's a practical tip that costs you nothing and takes about 10 minutes to set up. Open a separate bank account purely for your prop firm payouts and any related expenses. This keeps everything clean, it makes your accountant's job faster and considerably cheaper, and it gives HMRC nothing to be confused about if they ever do ask you questions. If you're doing more than a handful of transactions a month, a piece of bookkeeping software like Xero or QuickBooks can help too, but at lower volumes, a simple spreadsheet's completely fine as well. The key here is consistency and not sophistication. So this next one trips people up constantly, so let's slow right down and get into it completely clear. There are actually 2 separate rules involving the number £1,000, and people conflate them all the time in comment sections online. Rule 1, if your total prop firm turnover across the entire tax year is under £1,000, that alone generally does not trigger a requirement to file a self-assessment tax return. I want to stress this is turnover, meaning total money in, not profit. And I say generally because there can be other reasons you are required to file regardless of this threshold. So do not treat it as an automatic exemption in every case. The moment your turnover goes over £1,000, a return is required, even if your actual profit after expenses is very small. Rule 2, and this is a completely separate thing. Everyone gets what's called a trading allowance of £1,000, which you can deduct from your profit instead of using your actual real expenses. And this is useful specifically if your real expenses happen to be lower than £1,000 because it gives you a bigger deduction than your real numbers would. Important here, you cannot use both your actual expenses and the trading allowance at the same time. It's whichever one gives you the better result for that year. And one final thing I want to remember from this slide, filing a tax return and owing tax are two completely different things. You can absolutely file a return that shows £0 owed. Filing the return itself is about declaring the activity, not necessarily about paying anything. So we'll talk here quickly about choosing an accountant because generic accountants get this wrong more often than you'd think, and picking the right one makes a genuine difference. So here are some red flag phases to listen out for. If an accountant says you'll pay capital gains tax on that, that's a red flag because we've already established prop firm income is not capital gains. If they say I'll need to research it and get back to you, that suggests they haven't dealt with this specific type of income before. And generally, any uncertainty at all about whether prop firm payouts are even taxable in the first place is a clear sign to probably look somewhere else. Here are 3 questions worth asking before you sign up with anyone. Do you currently have any clients who trade with prop firms? Do you know how prop firm payouts are classified for tax purposes? And have you filed a return before that included this specific kind of income in terms of cost? A specialist accountant who genuinely understands this space typically charges somewhere between £850 and £3,000, depending on how complex your situation is. And remember that fee itself is deductible business expense, so it's not quite as expensive as the headline number might suggest. So let's bring this all together into a practical action plan. If you take away nothing else from this entire guide, take away these 4 steps. Step 1. Register as a sole trader as soon as you start receiving payouts, even small ones. It's free, it's quick, and it keeps you compliant from day one rather than trying to backdate everything later. Step 2, set aside 25 to 35% of every single payout you receive and move it into a separate account immediately. A quick practical tip here that has nothing to do with tax law, but is just good cash management. Put that money into a high interest savings account rather than leave it sitting in your current account. Your tax isn't actually due until the following January, so that money can be earning interest for you in the meantime instead of sitting there doing nothing, as long as it's still in there, as long as it's still there in full when the bill arrives. This matters because prop firms typically pay out within days of you invoicing them, and it's very easy to spend money that is in reality already owed to HMRC. Step 3, track your income and expenses consistently. A simple spreadsheet's completely fine, and if your volume is low, keep every receipt. Consistency matters far more here than sophistication of tools. And step 4, revisit your business structure once your income becomes consistent. Once you're earning enough, consistently enough, that a limited company might help you, have that specific conversation with a specialist accountant using your actual current numbers, not a rule of thumb from a video you watched once. So before we wrap up, let's run through a few frequently asked questions because these are the ones that come up almost every single time a guide like this goes out. Can I claim failed challenge fees? Generally, yes, provided they're wholly and exclusively for your trading business. A retake fee is normally a cost of doing this activity, and it isn't excluded just because that particular attempt happened to fail. Do I need to register before my first payout? Register as soon as you know you're trading with the intention of making a profit. Don't wait until money's landed in your account. HMRC does give you a window of time after you start trading to get registered, but starting that process early removes any risk of accidentally missing a deadline. What if I'm paid in USDC or another cryptocurrency? It's still taxable income valued in pounds sterling at the point you receive it. Converting your payout into crypto doesn't change its classification as income, but it does add a layer of complexity around valuation and record keeping, so flag that to your accountant if it applies to you. What if I trade with multiple prop firms at once? All of your payouts from all of your firms get combined together as your total trading income for the year. There's no separate allowance or threshold that applies per firm. It's all one pot for tax purposes. Can I backdate business expenses? You can generally claim what are called pre-trading expenses, meaning cost incurred shortly before you started trading, but there are specific rules around exactly how far back that goes and what qualifies. Keep every receipt regardless and let your accountant apply the rules correctly rather than assuming yourself. And finally, do I need a business bank account? It's not a legal requirement for a sole trader, but as I mentioned earlier in the record keeping section, it's strongly recommended. In practice, once your volume of payouts and expenses pick up, it stops being optional and starts being the only sane way to manage all of this. So just a quick summary of everything we've covered so far. Framed as common claims versus the actual position. So claim, prop firm payouts are tax-free. False. They're taxed as trading or self-employment income. Claim. An offshore firm meets HMRC can't see it. False. You're taxed based on where you are a resident, not where the firm's based. Claim. Under £1,000 total means nothing to declare. This is a turnover-based rule, not a profit-based one, so check carefully which situation applies to you. A limited company is always more tax efficient, not necessarily, as we've seen that gap has narrowed significantly with current tax rates. Class 4 national insurance is 9%. It's 6% for the 2025 to 2026 tax year. Rates have dropped, so always verify the current figure. And claim additional rate tax starts at £150,000. It's £125,140, and that's a very commonly repeated outdated figure still being shared online. I'm just going to leave this slide up for a moment in case you want to screenshot it, because this genuinely is the whole guide compressed down into 6 corrections basically. And as I said right at the start of this guide, I want to leave you with the same message that I open with. Everything discussed in this guide is for educational and entertainment purposes only. It does not constitute financial, tax or legal advice, and nothing in this presentation should be relied upon as a substitute for advice from a qualified professional. I'm not a certified or qualified accountant, tax advisor or financial professional. Every figure in this guide was checked against current HMRC guidance at the time of recording, but rules change and individual circumstances vary significantly from person to person. Please consult a qualified accountant, ideally one experienced with traders and prop firm income specifically, before acting on anything discussed in this guide. Thank you so much for watching this all the way through. I know it's a long one. If you've got any questions, drop them below and I'll do my best to get back to you as best as I can. Take care, and I will catch you in the next one.